Well, good morning, everyone, and welcome to the final installment of the Risk and Management Adjustment series. And today, I, Mark Fenton, will be going over 2 trades for hedging your portfolio. I am the senior mentor here at Sheridan Mentoring. Been with Dan mentoring people for now about 10 years. Been a full-time trader for that length of time also. Retail from my home, wasn't a floor trader or anything. And also, before that, I was in a regular job, and I just built myself up trading over the years. Took Dan's program back in 2005. It worked so well for me, I was able to switch careers to being a full-time trader and then a mentor. That's how I got to here. Along the way, I may shag questions and answer them here along the way. Sometimes I might hold them for a while and catch maybe some more at the end. I actually have one question from Robert. 30 days expiration for each $1,000 of the SPX stocks. I don't use that, Robert. Okay. So couldn't help you on that. All right, so let's get started here. Everybody should be seeing the presentation. So today I'm going to talk about a couple of flies. One is the SPX bearish butterfly. Sometimes you might even hear about it being called a time bomb butterfly. I was published on it actually in Modern Trader magazine. I think it used to be Futures magazine. I was Modern Trader like March of 2015. I think it got published on it. You can find that article back there. And then SPX back ratio call spread. So we're going to look at those 2 trades today as a method of hedging, and you can also use them as a method of speculation in your account. Okay, so a little bit about hedging. First off, hedging, of course, involves taking some of the risk that you have off the table, similar to what you do with your car insurance, right? Maybe you have a $1,000 deductible, you pay a premium every month, and you're saying, okay, insurance company, I gave you $150 a month. I'll cover the first 1,000 if I have an accident. After that, it's on you. And that's really what hedging is. You're saying I can take a $1,000 hit. I don't want to take a $20,000 hit or whatever it may be on a car accident. So that's what you're doing. So the amount of hedging that you do involves how much risk you want to take. How much are you willing to lose? How much are you willing to risk losing? So there's a lot of, I guess you could say, fuzziness to how much you buy or sell or whatever a particular hedge idea, because it's all about the amount of money that you're trying to protect, the size of the portfolio you're trying to protect. So along the way here, there won't necessarily be hard and fast rules on how much of anything to do. Only a couple of trades that you can use to do it, and then you dial those in to the size you'll need for the amount of risk you're wanting to lay off or are you willing to accept. All right? And remember, a hedge, a lot of times you have to look at a hedge trade just like you do your car insurance. What happens if I pay $150 a month for my car insurance for the next 10 years and never have an accident? All right, I lost $150 a month, didn't I, for the next 10 years, and I never got anything out of it. And that's how you have to look at a lot of hedging trades. Sometimes people look at hedging trades and go, oh, wait a minute, you know, I'm getting buried on this one or whatever. And some hedging trades you can go ahead and take off early, but a lot of times you really wouldn't want to remove a trade just because you're losing on it if it's truly there to help you in case of a downturn. So the first one we're going to talk about is the SPX bearish butterfly. Now, it's useful to protect part of your portfolio against a general market decline because an SPX is a general market index, isn't it? And before you do it, though, you have to consider how long you want the protection and what your price target is. Where do you think SPX is going? All right, so it's sort of based on your prediction / fear. But if you're sitting here today and you want to put on an SPX bearish butterfly to help you if the market declines, you have to decide when you think that decline might be or when you fear it will be, and where you think that number is that it's going to. as you'll see more as we structure this. So here's an SPX yearly chart. Now, I'm not a big chart reader, as I know some people are really into it. I have been over the years, but I've found they're not a terrific amount of use, maybe a little support and resistance or something. That's my opinion. But let's suppose you were looking at this and you might say, well, you know, if we really got into a pretty good free fall, there's not a whole lot of support till at least, what, 2350, maybe a little around 2400, but, you know, 2350 is where I'm really afraid this thing could go. And then you have to decide when you think it will get there. All right? So how do you set up the trade? So if you do the bearish SPX fly, what you do generally is you say, okay, I'm afraid it's going to go to 1350 in this example. So you set up a butterfly down there, and I would use puts. That way, you know, you're below the market. And a lot of times I start looking at 20-point wide. You can do 10, you can do 30, whatever you want to do. Now, of course, the wider your wings are, the more area will be at least somewhat profitable. More room for the tent will be larger, and we'll look at some of those examples. But the tent will be larger for your pricing to get into, but it'll also cost you more. But in the example I gave here, I bought a 2370 put, and then you sell two 2350 puts and buy one 2330 put. So this is a symmetrical butterfly in this example. And like I said, the expiration you choose will be based on how long you want the protection, or maybe even more aptly, when you think that decline might happen. And of course, the size, not only the size, but the width will be based on how much protection you need and want, and how much money you want to spend, right? Just to continue on with the sample trade, you close this trade when the market declines into the butterfly, and you hit the, you know, it gives you that support, that extra money you were looking. You're looking for this trade to work, while maybe some other SPX or other general market trades you might have, even stocks, aren't working. This can give you a winner in a general market decline. And you can close the trade at a loss of your choosing. Like I said, a lot of times I like to put these on, and if I can, put them on at a level where I'm setting it, forgetting it, and probably not going to take it off. I'm just going to let it stay there in case I need it. So the SPX bearish butterfly risk graph looks something like this. And we'll look at one live here on my Analyze page in a little bit. But as I said, the SPX, I set these slides up yesterday, but this whole thing's still relevant today. SPX was trading at 2450 yesterday. And well, it's about the same today, isn't it? This was that exact trade. And in this case, I put it on about a month away, September 22nd. So anytime, if you had this trade on today between now and September 22nd, that the SPX declined down into the inside the graph of that butterfly, roughly what would that be? A little below 2370, all the way down to around 2330 roughly. You could be profitable. Now, the closer to expiration that you get, the more profitable you would be. If you've done some butterflies, you know that they explode more in the inside of the graph, and you make more money in the graph the closer they are to expiration, right? If we went down there today, as you can see, we'd be profitable, but we wouldn't make that much money compared with what we could make because it's a little bit early. But that's how this trade should look if you had a risk graph you were looking at. So the SPX recently reached this all-time high of 2490. So that's another thing that we're going to be relevant with our next trade, the back ratio call spread. Now, before I go on to that, I am going to give an example of the SPX back ratio and the time bomb put butterfly, bearish butterfly, whatever you want to call it, here when I'm done with the slides. But if you have any questions you'd like to ask now about it, go ahead before we even move on to the back ratio. Be happy to take those now. If you have questions, put them in the chat feature. We don't use the question and answer feature here. Too many places to look for the questions that way, so we try to limit it to the chat feature. I see one questioner, what's your portfolio return to date? My portfolio return to dates, you know, to me, I'm going to just say this once. If you follow a good plan, generally speaking, you have good mentoring. I believe if you can follow a plan on average, over time, over years and years of time, a person can make 5 to 7% a month on their risk capital in their portfolio that they're using. That's 5 to 7% a month. I didn't say a year and I didn't say a week, all right? That's my opinion on what I think a person can do with the proper coachability and the proper training over time, learning risk management, right? So I'll just leave that at that. VIX calls as a hedge. Well, certainly, Leo, we all know I like those. Not a topic that I'm going to cover here today in this general class. Some of the stuff that we do over inside the Sheridan community, to me, requires a little more advanced, a little more work. So I won't be discussing those here today. That's something I talk about if you're inside of our community. Did you talk about when you would look to insure other than just feeling down to risk? No, I didn't. In fact, I even said at the beginning, Wallace, that when and how much insurance you get, that's all up to you based on how much risk you think there is, how much you're willing to pay for it, and how much risk you're willing to assume. How much of a chance do you want to take? So both of these trades are really dialed in by you. I'm giving you a structure, and then you're dialing in where you think that the SPX, in this case, might go, or when it's going to get there, and how much money you want it to make when it does. I do not use technical indicators whatsoever, Bill, in anything I do, including butterflies. And then use open interest. No, I do not. I'm not talking about repairs here today, but I'm going to talk about these other two trades. All right, so let's move on to the SPX back ratio call spread. As we can see, up when we were at 24.90, that appears to be, it certainly is a recent high. How far is it going to go? Well, no one knows, right? So is it going to go down? Is it going to go back up? So what you can do if you really feel like, hey, I'm not too fearful of the upside, I'm more afraid of the market going down. How can I hedge myself a little? Well, the SPX back ratio call spread, as I will show, is something you can use. I usually put them on around 30 days to expiration, and I sell a 1/30 delta call, or approximately. Could it be 28 deltas or 32 deltas? It certainly could, all right? So around that. And then I buy 2 calls 30 points higher than wherever that 30 delta call was. Now, this trade, I also don't adjust. I just close it at a 10% gain or loss. You can set your own parameters. You want to do 15 and 15 or whatever, you can. But I don't do any adjustment with this trade. So it looks something like this. So this was yesterday, of course, but I went out to September 22nd, and the 30 delta call at the time I did this, when we were around 24.50, was the 24.80, I believe it was. And then I sold that, and then I went above it and bought 2 calls at 25.10. I could have those numbers off small on my screen, but you get the point. Sold the 30 delta call, went up 30 points from there. And then we were at 24.50, and as you can see, I'm well inside of the risk graph. You take in a credit for this trade. Now, the cost of your trade, of course, is margin, whatever it may be. In this case, it should be $3,000 because you have one contract 30 points wide minus whatever credit you got. And that's the most amount of money you could ever make as the credit. But as you can see, if this trade goes against you, well, if it went against you in the beginning and went really hard to the upside, you could still make money. But if it gets out there in what we call a sea of death, where you're just hanging out where the risk graph or expiration is below 0, you'll get negative theta and you'll lose more and more money until you have your max loss on the trade. But otherwise, if it stays where it's at, when we put this on around 24.50, maybe it goes up a little or goes down to zero, you still make money because you put this on at a credit. All right, so I'm going to go ahead and just show you one of each of these live in today's market, just to walk through it, and then we'll take some more questions. So the first one, we'll talk about the SPX bearish butterfly, time bomb butterfly, whatever you want to call it. And, you know, you can pick any time period. What if I thought, hey, by right after Labor Day, Step 8th, you know, I think that the market, let's just say we think it's just going to decline to 2,400. I gave you the example of 2,350, but let's look at 2,400 just in case we might think it would decline to there. So you go to 2,400, right click, buy, butterfly if you're using this software, and then let's just say we looked at it 20 points wide. So your upper puts 2,420, 2,400, and then down to 2,380. Now let's take a look at it. Trade looks like this. Now this trade cost me, if I did one contract, you see here $1.25 or 125 bucks. And if it starts declining, I could start making money. And as you can see, let's suppose I'm right. Well, you wouldn't generally stay till expiration day, but if you did, you could pick up 1,800 bucks. If it was really around 2,400, 1,100 bucks on expiration. But let's just see what it would look like even that week. Let's say we come back the day after Labor Day, which is, boom, the 5th. And on the 5th, we make that decline. Well, for every one of these you have on, in a pretty good size of the tip, you could be making high 3s to 400 bucks. So just kind of an example, let's suppose that you want to hedge $5,000 worth of risk. Maybe you have a $30,000 portfolio and you only want to risk losing 5 of it at the most. You know, what could you do? Well, you could just buy more and more of these until maybe we were in there, we were at that level. Now that would be a pretty good sized trade, but you get the point, right? You could pick this, you could buy 20 of these, which would be about $2,000, a little over. You could hedge and have $7,000 or $8,000 in money you made if it comes down into here at the right time. Now, of course, the problem is if it blows through, you may make money, depends on when it does it. And if it stays up here too long, then you're going to have a problem, right? But that's how you would set this trade up, and that is what it would look like. So that's the SPX time bomb flag. I'm just going to leave this. I'm going to undo it. And now we're going to talk about that back ratio. Now, of course, the time bomb fly requires sometime or another, it has to make its move towards that graph or get in it, right? If it goes too far or never moves at all down or goes up, you lose money. So if nothing happens, you would just lose money. So let's go to the back ratio. So the back ratio, I do like a little more time on those usually. So I'd probably go out a little further than just step 8. Let's see, what would it be? What if you just went to step 15th? Let's look at a 30 delta call. So we'll go over here on the call side. And we're going to find a call with 30 deltas, what I think blew by it. Here's 29 or 33, kind of your choice. You have to pick the 2470 or the 75. Let's just go with the 75, the 29 delta. So there you're buying, what they call buying, a back ratio. Let me give you more room here so you can see what I'm doing. We're not going to be looking at this at the same time. So if I sell the 2475 and I want to go up 30 points, that puts me at 2505. That's a $4.80 credit. You see that here? So you're going to take in $480. This trade's going to cost you $3,000 in margin, less $480. So the trade's going to be just over $2,500 that they're going to hold out of your account as long as this is open for every one of these that you did. So now let's look at the risk profile. So if we stay here, go up some, doesn't matter. Ultimately, you can make $480. Even if we go to zero, since you sold a credit, you're making $480 because you sold a call at $24.75. If we never get there, for expiration, you're never going to lose money, right? You wouldn't be in the money on any shorts or anything. So if it goes down or stays here or goes up a little, you're fine. As I said, I like to use maybe a 10% at the most. I'm really willing to lose. So if this trade costs me $2,500, I might be willing to risk up to $250, but that's it. If it's more than that, I'll close it. And similarly, on the downside, probably take a $250 credit. Now, if it really gets running hard, sometimes you might say, hey, I'll just wait. If you woke up the day after Labor Day and we had some 40, 50-point down move, then you might just hang out down here because it would be a long way back for it to ever go against you. You might be able to get the whole $400 if you let it go to expiration. And if you did, you could just let it expire worthless. You wouldn't have to close anything because nothing would be in the money or anything. You wouldn't have to, it's cash settled. So that's two trades you can use, and once again, size them. So you can make, if the market really did decline, you can make $500 for every one of these you have on. So you have to decide how much money you're willing to risk versus how much money you want to make. So that's what I have on these. So I'm going to go back and just look at some questions. If you have questions, put them in here. Now is the time for your questions. Is the ratio butterfly a repair for a butterfly? I don't use it as one, Bill. The back ratio seems much better with it being a winner if the market doesn't drop as well as if it does. Well, it is nice, other than it's more expensive and you're risking more if you do it. Depends on how much size, but it can be much more risky for what you're getting out of it, right? The risk reward is different. Okay. And could you do the ratio fly as 1-4-3 for a credit? Yeah, I suppose you could set it up that way. Eric, there's a lot of, in options, you have a lot of options, pardon the pun. There's a lot of different ways you can do things with options. Depending on, your knowledge of them, you should certainly understand anything you're doing and when and how you're going to get in it, execute it, adjust it, or flat get out of it, or take a profit. If you don't know the answer to those questions, you shouldn't be putting a trade on. But yes, you could do that. I suppose you could structure it in such a fashion. Yes, I think you used to do those a lot on timing some Fed announcements. What we're trying to do here is just give you some general ideas on how you can hedge a portfolio. Of course, there's more to option trading than that, and if you truly want to know how to trade options for monthly income, I encourage you to go to our site and check out our mentoring program. There's a lot of different ways you can do it. But one-on-one mentoring with somebody who's experienced in trading is invaluable, and will do much more than any classes or YouTube videos you're going to watch because it's dialed in for you. And different market sequences because mentoring takes place over several months. So you have different market environments, and you learn how to handle yourself in those, as well as some accountability. Because, like somebody said earlier, how do I decide I want to do these flies, or do I just go by feel or what? And that's what can happen to you when you're trading in general. You have to learn, through practice, not to do what you feel. You have to assess your risk versus your reward. And then you have to stick to that. If you listen to CNBC or whatever, and you worry every time you say something's going to go down and you go buy puts, that's going to lead you to a lot of losses. Because, as you know, people on pundits, talking heads, they're not right a lot, are they? And they're wrong a lot. So you got to be careful with that. So any other questions on these two trades that I went over today? Give you a little bit to come up with them if you do. I appreciate you guys coming out and listening to what I did show and talk about. I think those are two interesting trades. I've used this time bomb. I've used the back ratio, but I have used this time bomb a ton. I use it in earnings plays too, where you want to pick a direction very short term. Maybe you think after earnings, Google's going to go up at $80 or down, or Amazon or whatever. It can be very helpful for that too. All right. Well, I'm not seeing any other questions, so I guess we can leave it at that today. Like I said, I encourage you, check out our site, check out our upcoming classes, really take a look at mentoring. I think that you will I think you'll find if you talk to people that are in our mentoring program that it's done a lot for them. Taking sometimes people who know very little and turn them into an effective trader. Okay? All right. Well, thanks, folks.